All right. Hello, ladies and gentlemen. Let's see here. Let's get this view full screen. All right. Before I get into this, first thing I want to say is I've been having some strange dealings with Loom Video. Sometimes it skips a lot and it cuts at places where I don't necessarily want it to cut. So sorry in advance. Sometimes you just got to get it out, and I try to get past perfectionism, which really slows you down in life. Just kind of get the message out. So that is what I aim to do today. So you can see I developed this very fancy graphic really quickly on Google Slides. This is why we passed on this deal. And this is the second one of these that I'm going to just going to continue to show why a deal just doesn't meet our criteria, and why at this time, we've been really slow in terms of our activity and what we're finding, and not feeling comfortable bringing out to our investors. So let's dive in. You're going to notice some red here. That's crossing off some clues as to where this deal is and who it came from, because I really know and like and respect these partners that we work with. And I don't want to speak badly on their deal. In their opinion, they feel like it's a good deal, and some just great things about it that are tempting. And I can understand why they did the deal. Just didn't meet our criteria completely. So we're going to do this likes and dislikes. We're not going to really dive into underwriting or anything too numbers wise. This is more of just the general takeaways of what caused us to not move forward with this deal. And then the red writing that you see there, initially my thoughts were positive, and then I wrote in red later, finding out that things weren't quite like I thought originally. So those likes actually sort of became a dislike. All right, so in the beginning here, it is in. Sorry, can't tell you where it's at, but it is a good market. It's a solid market. I was excited about it, and that was one of the things that got me very intrigued. Had a strong cap rate at purchase for the market. Yes, comparatively speaking to a year and a half ago, the cap rate was high. Again, a high cap rate means you're paying a lower purchase price, so you're getting, a better deal. You're buying at a better cost basis than you would have a year and a half ago. But upon further review, considering some of the risk that was involved in this deal, I wanted that cap rate to actually be a little higher. So I would have liked to see the purchase price actually a little lower. Moving down here, we got B plus area. Again, this is sort of debatable. Upon further review, I found it was sort of a fringy area. The crime was a lot higher than I'm comfortable with. So even though it has a reputation of being sort of a B class area, upon further review, it was sort of a fringy, just on the fringe of that area. And in my opinion, just a not so great area, although the median income was solid. Strong employment area, that's true. Had access to good employment, absolutely. Great unit mix. This is maybe my favorite thing about the deal. It was a really nice mix of 1 and 2 bedrooms, actually mostly 2 bedrooms, which is always a good thing. This is sort of a precursor to a deal that I'm going to show that we passed on a little down the road as to what I didn't like about this deal. But the particular deal that we're talking about today, really liked the unit mix. Again, made it intriguing. Proof of concept, about 3/4 of the units remain in classic condition. That's always a good thing. That means there's a lot of value remaining to be added potentially. So for those that don't know, a classic unit is just an untouched unit. It's in its original condition. So this was a 1972 vintage, so those are quite outdated. And once they're updated, that's going to bring up the value of the property. Good amenities package, yeah, it had that. Good sales and rental comps. At first glance, it seemed like it was a lower basis, and this kind of ties into the cap rate. It was a low basis for the market, and when I saw that at first, I was like, oh, wow, this looks like a great buy. But then when I went and did my own comp study, I found that if you found the other comps with the exact same vintage in the close proximity, it was really just on par, meaning, they were getting it at the right price. It just wasn't like a heck of a deal, like well below some of the other comps, which the average of all the comps that were in their comp study were quite a bit higher than their price per unit here. But again, if you just narrowed it down to similar vintages, it was really just right on par. Nothing too special, but not bad, just not great. Well capitalized, plenty of reserves. That's something these guys always do, and that's a huge pet peeve, to say the least. So good for them. They always do that, and that's why I always feel comfortable investing with these operators. Okay, so let's move on to the fun stuff. Yeah, I thought that there was a lot of CapEx that needed to be done to each unit to achieve what I considered to be pretty average returns. You know, if there was a lot of upside and reward for so much CapEx going in, so much cost and renovation, it might be worth that risk. Although right now in this environment, didn't feel comfortable putting in that much into each unit in this current economic environment, as well as in this submarket, which I felt was just a little, fringy, like I say, just a little rough around the edges. And then a big one was the old, do try to keep it mid 80s and above. I have a few exceptions with operators that I do trust that, hey, they're great, C-class, and that's their wheelhouse. That's what they do well and always seem to have great results, and I trust them for that. Not to say these guys can't. It just didn't help and didn't make me feel comfortable. It has to be an exception if I'm going to go with an older vintage. And in this case, it just wasn't there for me. And then this is a biggie. Looks like a D on crime rate grade. If you look at the area, it was pretty rough, like I say. And that can just be too much work. I think you're going to be constantly turning over tenants. People aren't going to feel comfortable living there. Speaking about, potential new tenants coming into that area, if they see it's a high crime area, they're not going to want to live there. Some people economically that's all they can afford. That's unfortunate, but that plays into how difficult the task at hand will be if you're going to have sort of a tenant base that's accustomed to living in that sort of area, and then not crazy about the demographic. That sort of ties into that point above it on the crime grade. The interest rate, this is, who knows really. I think it may not look great in a few years, but the stickier this inflation appears to be, these interest rates, they could be around for a while. So this one right here, who knows? Like I say here, that's debatable. I'm not going to tell you the interest rate. Just again, I don't want to give any clues, but yeah, it's a decent interest rate for right now. I just don't know what that's going to look like in a couple of years from now. Only had 1 year interest only. I like to see more longer periods of interest only, because in commercial multifamily, these are relative to single multifamily. These are pretty short holds. They can be for as short as 5 years. The more you maximize interest only, you're not going to have to amortize the loan. And so that's just going to increase cash flow, and that's going to increase your returns. Now, if you're holding for a long period of time, you do want to amortize down that loan. You want to pay down that loan eventually so you can gain more equity. But in the relative short-term game that commercial real estate is, the more you can, interest only, you can pay and not have to amortize the loan, pay down principal, the more you can increase cash flow. So 1 year, pretty short. Sometimes we'll get 3 is a good year. We've gotten as high as 5 years. So anywhere 3 to 5 years is a good period for interest only. Average cash flow for C-class. Yeah, it was, hopefully I'm not giving away anything, but it was sort of in the 6% range. And I mean, this is, times are changing. We're not getting the returns we were a few years back. A lot of that has to do with interest rates, inflation, insurance, property tax, you name it. So it's understandable that the cash on cash was quite low for a C-class. But I have seen this type of cash flow available on nicer B-class and even A-class, at least 5% for A-class, 5 to 6% for A-class. So if it's going to be C-class, I'd like to see higher cash on cash. And yeah, this the deal breaker, just not enough reward for the risk. These are sort of like A and B class type returns on a C class property. You want to be rewarded. If you're going to do a C class property, you should expect higher upside. The rougher the property, the more risk you're taking, and the greater the upside if you can really turn that property around and improve it with renovations, improve its reputation within the community, and bring it up on par with some of the surrounding community. But I just felt like the whole area on its own was sort of tough, and it's always tough to bring up an entire area, much less just trying to bring up the reputation of a single property. So that's it. Those are sort of my takeaways. Didn't really dive deep into any underwriting or anything here, but sometimes you don't have to. You can just do the broad strokes, and that will give you the answer you need, whether you're going to move forward or not move forward with a deal. So I hope you got something out of that. Thanks for listening, for those of you who hung around, and we'll see you on the next one of these, okay? Thanks a lot. See you.